welcome back. This is Investment 360. It's all about asset allocation tonight. It says here that asset allocation is to deliver the best returns in the current economic climate. It goes on to say, the article from Southern Charter, incidentally, is picking the right combination of stocks, bonds and real assets create a unique risk-return profile for a portfolio. In the Cape Town studio with me tonight on Investment 360 is Mark Thompson from Southern Charter. Mark, you've done well over the last few years at the Morningstar Awards, so congratulations on that. But why is asset allocation so important?
Good evening, Lindsay. Asset allocation, when we look at it, when you're investing in anything, you need to decide what your risk profile is first before you begin. So asset allocation to us, we have 3 different levels of funds and 3 different levels of risk profile. And when you're wanting to meet an investor's needs, you need to establish first what the risk profile is and then match the asset allocation with the risk profile that the client is looking for. So it's very client-orientated.
So it's a bespoke sort of approach to investment.
We say we were one of the few people to have Harry Markowitz on our side during this period. And when we go back to 2007, 2008, I had this comment that I wasn't sure what was going on because the numbers didn't make sense. And if you didn't know what was going on, the best thing to do was to make sure that your asset allocation was 100% correct. And we looked at the models and we got research done for us, which was 60 years of number crunching. And the models that came out, as we went through the sort of 3-year track record, we found ourselves in sort of the number 1 spot. 2012, we won the Fund House of the Year. 2013, we won the Fund House of the Year, and we were the run-up again. And as a multi-manager, multi-asset class, I can only humbly say thank you to Harry Markowitz for giving us
That's enough of an advertisement for you now, Mark. Let's get on with the theory behind this and what you're doing. I can't believe these statistics. It says here, you must be pulling my leg, it says research indicates that asset allocation produces 92% of return, with only 2% resulting from market timing and 6% from stock picking. 92%. 92%.
That was a research done by Brinson in the United States. And it's actually, interestingly enough, the models that we use, they use for the Harvard endowments, and it's based on this very similar statistic and very similar outcomes. I mean, if you had a look at our outcomes, the returns that we've got have been from asset allocation. And earlier in the evening, you were talking about listed property. Listed property gave a tremendous return in the last 10 years. In fact, it surpassed equities. And if you had been focusing only on equities, well, you would have missed out on listed property, just as an example.
Yeah.
I mean, as the interest rates change, now I think listed property might take a little bit of a hammering. And you'd be looking for new asset classes. In the prior year, this last year, 2013, if you weren't 25% offshore in your Regulation 28 funds, you would have had pain, because the currency, not that we're investing for currency, we're investing for valuations, based on the valuations. But the valuations were the first decision. The currency gave the benefit.
Let's talk about Regulation 28 funds. The Southern Charter Met Growth Fund of Funds as at 31st of January 2014. Pretty impressive stuff. Tell us about that fund. And also, if you would, tell us how quickly, as an asset allocator, you can change your asset allocation. So the fund first.
The fund first. The fund it has a maximum of 25%. You can't have more than 75% in equities. Our benchmark is 70% in equities.
Yeah.
So at any time, we're actually on the benchmark at 70%, with 3 fund managers below that: Prudential, Foot, and Mazee. And when we looked at those fund manager selection, we selected them on the basis also of asset allocation. We thought, how much attention did they pay to asset allocation? You might have a deep value fund, but you have to give your clients a return every year. So the structure of the fund, I mean, it has an allocation to property, to offshore property, to bonds. And what we do is we look at the allocation, look at the valuations daily. But our decisions are made on a much longer term horizon. For example, the US Treasury bond rate might give us a huge indication which way the market's going.
2.8% incidentally today. It wasn't that long ago. It was 2.6%.
Yeah. No, 2.8%. I mean, I think what people don't realize is that if you go back a few months, it was actually 1.5. It went from 1.5 to 3% in 5 months, which is like almost a straight line in the opposite direction. And then you get all this noise in the market, and you're wondering what's going on, and the journalists are writing stories as to what's happening. But the US long-term 10-year Treasury bond rate is a very key indicator to us, and that would be a starting point to see what's happening. We're in a global market, and what happens in the US affects us.
So when you saw the jobs number coming out of the United States on Friday, which beat expectations, and therefore the bond rate started ticking higher, do you say to yourselves, let's sit down and have a look at our asset allocation model and start tweaking it?
Well, we'd be saying it probably would be confirming what we thought was happening, because that bond rate moved from 1.5 to 3, which was probably the last time that did it was in the other direction in 2008, 2009. So there's a lot of noise, and there may be overreaction. So we take a number of different indicators into account. That would be one of them, but it would have confirmed that the synchronized global growth is definitely on course.
Okay, so tell us about your ideal asset allocation now. You're talking about 70% equities.
Yeah,
is it going to stay there at that elevated level?
Yeah, it's, you know, the target is CPI plus 7, so it's 1% below what the market gives over a 60-year period. So the South African JSE will give you 8% real return over a 60-year period. We're targeting CPI plus 7 at half the risk of what the market is. So it's a much easier ride. Also, given that the Regulation 28 doesn't allow you to go beyond 75.
Yeah.
Also, which is really an interesting statistic, is our fund with 70% in equities actually beat the JSE All Share Index last year at half the risk. So that would give you some indication of the asset allocation working.
Let's have a look at the popularity of asset allocation funds, because you've sent me some more statistics. According to CISA, it says here, there were asset allocation funds attracting net inflows of 76 billion rand in 2012 and accounted for a total of 34% of the share of industry assets, up from 28% in 11. Is that upward trend continuing?
I think that definitely. I think what people are realizing, it really goes down to the objectives that they're setting themselves. They want absolute return funds. I think people are, having to report when the market's down and you're down minus 28 and you actually want to be positive. The nature of the game is that on an asset allocation fund, you want to protect on the downside and you want to get the growth on the upside. And if you get a consistently good return, that's what you're really after.
Anything you've seen over the last, the first 2 and a bit months of 2014 that has materially changed your asset allocation thoughts for 2014 compared to 2013? Yeah,
one thing that we have noticed, obviously the valuations are indicating that resources are an opportunity, and one thing that is a bit of an anomaly to me is that if the 10-year US Treasury bond rate moves from 1.5 to 3 or close to 3, and the job numbers are positive and the whole synchronized growth is on track, but the resources haven't yet responded to that. And yes, you may say that more mines might have come on track, more investments might be, but right now it doesn't make sense. So we do expect a change. I mean, we'd never go 50% into resources, but we'd starting to nibble at maybe we should have more resources in our funds.
So you're proactive, in other words. You do change to market conditions.
We do change.
Mark, we'll leave it there. Thanks very much for coming in this evening. That's Mark Thompson from Southern Charter. That's it for Investment 360. Coming up now is Your View. Start calling us, if you would, on 011 384 0598 and send us tweets at CNBC Africa, #YourView410. Your View will be back in a moment.